George Soros is one of the most successful Forex traders of all time. In 1992, he made a single trade that earned him over $1 billion. He saw that the British economy was struggling and that the government was in debt. He knew that the British pound was overvalued and destined for a fall. So he picked his trading gun and executed what's known as a short trade. He borrowed the British pounds and sold them for another currency, in this case, the German mark. When the pound inevitably fell, he bought them back at a lower price, returned them to the lender, and pocketed the difference. And that was how Soros made over $1 billion in a single trade. What Soros did is known basically as fundamental analysis. Just like you would research the local currency before planning a weekend getaway to a new country, Forex traders need to understand the economic, social, and political factors that influence the value of the currencies they trade. And that, in a nutshell, is what fundamental analysis is all about. Soros understood the fundamentals of the Great Britain pounds and its economy, and he used that knowledge to his advantage. Many retail traders today rave about technical analysis and largely ignore fundamental analysis. But it's important to know the fundamentals of the currency you're trading, just like the big dogs and hedge fund managers that focus on economic trends and divergences to make their trade decisions, earning them millions and even billions, as we saw in the case of George Soros shorting the GBP. Let me reiterate that if you want to succeed in Forex trading long-term, you need to understand the fundamentals. It's important you understand the economic, social, and political factors that influence currency values. This is an edge that will improve your success rate, and who knows, you could be the next George Soros. That's why in this video we'll explore the definition and concept of fundamental analysis, its driving elements, its importance in Forex trading, and how you can use it to make profitable trades. For a second, let's go back to the weekend getaway you're planning. You've heard great things about your dream destination, the food, the culture, and the people, but you're not familiar with the local currency. So as not to be caught off guard when you arrive, you decide to do some research. The starting point of your research is the exchange rate, but you quickly realize that's not enough. You need to understand the economic, social, and political factors that influence the value of the currency. You've asked questions like, is the country experiencing inflation? Is there political instability? Are there any major events or holidays that could impact the exchange rate? As you dive deeper into your research, you begin to realize just how important it is to understand these Forex fundamentals, as they can make the difference between a successful trip or a financial disaster. The same is true for Forex traders. Understanding Forex fundamentals is essential for success in the market. It's not just about checking exchange rates or following trends or applying technical indicators or mastering price actions or market structures. It's about studying the bigger picture, the factors that can make or break a currency's value. Proper fundamental analysis helps to determine if a particular asset or currency is overvalued, undervalued, or trading at fair market value. Trading without this knowledge is like walking blindly into a new city without any knowledge of the local currency. You might get lucky and make some smart choices, but more often than not, you'll end up losing money. So, if you want to succeed long-term in Forex trading, it's sacrosanct you take the time to learn about Forex fundamentals. It may not be the most exciting part of the process of trading, as it can be boring, but it's essential for making informed decisions about when and where to invest or execute trades. Now let's dive deeper into the world of fundamental analysis. The concept of fundamental analysis. Finding an asset's intrinsic value is one of the most important elements when performing a fundamental analysis of an asset. And there are two major elements that makes up the fundamentals for Forex trading and investment that helps to determine the intrinsic value of assets. The first major element that makes up fundamental analysis is microeconomics. Have you ever wondered why a Big Mac costs different in different countries? Is it because of the quality of the burger? Or maybe it's because of the location of the restaurant? Or is it the demand and supply of the burger? Well, the answer to this riddle lies in microeconomics. Microeconomics is the study of individual economic behavior. Microeconomics analyzes the behavior of individuals and firms in making decisions regarding the allocation of limited resources, focusing on how supply and demand determine prices and production in various markets. There you have it, your answer to the riddle. It's like studying the habits of ants. But instead of studying ants, you study yourself, you study your neighbors, you study me, and you study our economic activities. And if you're thinking, wow, this sounds exciting, then, my friend, your life is boring and you need to get out more. Just kidding. But in all seriousness, microeconomics is crucial to understanding Forex trading. It helps you understand the behavior of individual consumers, businesses, governments, and how they impact the value of currencies. Now let me give you an example. Imagine you're a coffee shop owner in Brazil, and you want to import coffee beans from Vietnam. You need to pay for those beans in Vietnamese dong, but you only have Brazilian real. So what do? You exchange your real for dong. and that's where microeconomics comes in. The exchange rate is determined mainly by the forces of demand and supply of those currencies. Therefore, as a business owner, it is essential to keep an eye on these factors to make informed decisions. This is important for businesses that need to import or export goods and services in different currencies, as changes in exchange rates can affect their costs and revenues. How does this relate to trading? By studying the behavior of individual consumers, businesses, and governments, we can predict the demand and supply of currencies and make profitable trades. And if you're thinking, wow, this sounds complicated, then, my friend, you need to watch more of our videos. We'll make sure to break it down for you in the simplest of terms. And that's a promise. To further gain an understanding into what microeconomics is, let's look at the key Microeconomic Factors that influence currency value and Forex trading. I know economics can be a bit dry and boring, but trust me, we'll make it fun for y'all. So let's get started. The first key microeconomic factor we'll talk about is consumer behavior. You know how you always see those crazy lines outside Apple stores whenever a new iPhone drops? Well, that's consumer behavior at play. When people want something, they'll do just about anything to get it. The same goes for currencies. If there's a high demand for a particular currency, its value goes up. So as traders, we need to keep an eye on what consumers want and adjust our trades accordingly. Next, let's look at businesses. Have you ever heard of the phrase time is money? Well, for businesses, that couldn't be more true. Businesses are always looking for ways to save time and money, and that's where Forex trading comes in. By exchanging currencies at the right time, businesses can save a ton of money on international transactions. And when businesses save money, their profits go up, which means more demand for their currency. Again, as traders, we need to stay on top of these trends and make smart trades. Finally, let's talk about government behavior. The government. The ones who always seem to mess everything up. But in all seriousness, their actions can have a huge impact on currency values. For example, if a government announces a new tax plan or policy change, it can either boost or crash the economy. As traders, we need to keep a close eye on these announcements and be ready to adjust our trades accordingly. So there you have microeconomics in simple terms. Consumer behavior, business trends, and government policies are all key microeconomic factors that impact currency values. And while it may seem overwhelming at first, just know that it's all like a game of Monopoly. But instead of buying properties, we're buying currencies. Keep an eye on the trends, make smart trades, and don't forget to collect your $200 when you pass go. Macroeconomics and its significance to Forex trading. While microeconomics zooms in on consumer behavior, individual business behavior, and individual government behavior, macroeconomics is all about the big picture. Macroeconomics studies the impacts of government policies and external factors on the economy as a whole. It studies the overall behavior of the economy, including issues such as GDP, inflation, and unemployment rates, and formulates economic and fiscal policies to address them. You might ask, what does that have to do with Forex trading? Oh, my dear friend, everything. Forex traders need to understand how the economy is doing as a whole to make informed trade decisions about the value of currencies. Let's say you're a Forex trader and you want to trade the US dollar against the euro. Now, if the US economy is doing well, that means people are buying more goods and services, which leads to an increase in demand for the dollar. This in turn leads to an increase in the value of the dollar against the euro. But wait, there's more. Macroeconomic factors like inflation, interest rates, and government policies can all impact the value of a currency. For example, if the US Federal Reserve raises interest rates, that can make the dollar more attractive to investors because it increases the yields on dollar-denominated assets, such as bonds, forex, and savings accounts. And this in turn leads to an increase in demand for the USD and consequently, the value of the USD. If you want a detailed fundamental analysis on the majorly traded currencies and how to apply them to your trades for better TARD results, check out this video with the link somewhere up here. In summary, retail Forex traders who solely rely on technical analysis and neglect fundamental analysis are like a barista who switches things up to start selling tea instead of coffee without researching his tea options or understanding the preferences of his customers and what drives their consumers' behaviors. He's simply relying on his skills as a barista to make the perfect cup of tea. These traders may have excellent chart reading skills, but they fail to understand the social, economic, and political factors that drives and impact currency values. And this can lead to poor trade executions, then poor results, and even big losses. So don't be like the barista. As a trader, take the time to understand and become a student of fundamentals before making your trade decisions. And I guarantee you that it will be the best trading decision you will ever make as it simplifies and gives meaning to the whole trading process. In the next couple of videos series, we will further break down the elements of macroeconomics such as business cycles, interest rates, government policies, fiscal and monetary, GDP, trade balance, and lots more, and also discuss in details how to analyze economic data for making informed trade decisions. If you made it to the end of this video, I appreciate you. Kindly hit the subscribe button, like this video if you learned something from it, and turn on your notification bell so as not to miss any of our informed contents when they drop. To your success. See you soon and happy trading.